Hi, everybody. I'm back again with Alejandro. And while we don't have a presentation today, we're just going to reflect on a year of Warren Buffett and Berkshire Hathaway investing decisions and Warren Buffett's investing principles, and think about where we think Warren Buffett and Berkshire could be headed next in 2025. So now that it's the holidays at the end of 2024, we're just wanting to reflect back on what did we learn from Warren Buffett. And among those things, we could see some of Buffett's principles in action this year based on some of the companies that Berkshire Hathaway bought and sold. And among some of the principles that you continue to study, Alejandro, what stands out to you about what's important to Buffett?
Hello, Michelle. Hello, everybody. Thanks for inviting me again. It's a pleasure. As you said, I did want to talk a little about his principles and recap because obviously recapping all these principles helps us go through the year and prepare for the next year to be able to have everything fresh and do good investments. And some of the principles I think is he applied this year, as you said, are how he is always trying to look for the intrinsic value of a company. And how I see this how he, for example, started selling Apple because he, I mean, probably thought that it was too expensive. So I guess he started cutting down a little on it, and that is the reason he sold because he probably values it. He constantly reads about it. And he gets his alternatives. Um, I like that one. What about you?
Yeah, and in a similar way, there's a principle about resource allocation that Buffett probably has in mind, and similar to what you mentioned about the intrinsic value, is that the step that Buffett takes after he thinks something has reached its full intrinsic value is he might reallocate to a company that he thinks can be in a better position to generate more earnings. And that could be maybe he or some of his investing team members, maybe they found other companies that they think are better bets in terms of getting a better return on their money. Or for now, maybe there weren't that many companies on sale. So instead of being able to allocate money to an external publicly traded company, maybe they invested internally. They could have reallocated the cash into their fully owned subsidiaries. So it's possible that one of the reasons Berkshire Hathaway itself as a company performed well in the stock market is they probably generated significant returns that the stock market noticed. And in addition to that, Buffett allocated a lot of cash to US Treasury bonds and equivalents. So I think they have over $325 billion in just cash, which is like probably 40% of what Berkshire is worth or something like that. I'm just using rough figures, but it's amazing the principle of cash allocation. Like, how do you decide what do you put your money in? And that's something that Buffett continues to show in action.
And one thing to add on that is that how I don't know if you have heard, but I have many friends that say, "Oh, he knows it's a crash coming and something is going to happen, and that's why he's selling." And obviously, we as Buffett students, we know that's not the case. I mean, he's selling exactly because he thinks the intrinsic value of those companies is either getting to a top or his hypothesis on those companies change. Maybe now he doesn't see Apple being so irresistible as it was, or maybe, like you said, the price is too too high. But something very important to keep in mind is that he doesn't do that just to because he thinks he's trying to predict the stock market crash or anything, which a lot of people that just like to make opinions and maybe have not studied Buffett as deep as, I mean, the ones that we love and do start saying that type of thing. And that's very important to be clear. He's very disciplined. He's done it through all these years. And if he is selling, is because he thinks it's too high, and maybe he thinks putting that money into treasuries like he does, 3 months, 4 months, 6 months, or whatever, um, is a better value for his money, and that's the reason he's investing on it.
Yeah. And that reminds me of opportunity cost is it seems to show a lot that Buffett would rather settle for just getting a maybe 4 to 5% return than stay in one of the best companies in the world, Apple, which is, interestingly, since Buffett sold, like the stock had gone as low as about $160 a share. But since he sold, Apple is now close to $250 a share. So, you would think he should have stayed in the golden goose, but he let go of the golden goose and is settling for kind of mediocre returns. So he's probably thinking that there's got to be a better investing opportunity somewhere, or maybe he's getting ready to buy a whole company that will take billions of dollars. I don't know, but it's interesting how, we're learning about opportunity costs. Like, is it better to leave a stock and then you might miss out on future gains because you can't predict the future? So you have to pick and choose, certain opportunities.
Yeah, absolutely. An opportunity cost reminds me a lot of Charlie because he will always like to teach us about that. And um yeah, and as you said, I mean, Apple, who knows what's going to happen? As you said, it's not predictable. One of the things he always says on which is, I do want to recap, is how he always says you need to understand a company, and to him, understanding is being able to predict with a big degree of certainty how X company is going to look in 20 or 10 years. So that is very, very important. And on that, I do want to add some of the things. I mean, Bill Ackman and Lilu, how um, they're two like crazy investments. I want to mention this is because, even doctors die, and you know how Lilu was big, invested very big on Meta, and I mentioned, obviously they are both like Buffett fans. That's why I mentioned them. Um, how he was super invested on Meta, and he had, like, I don't know, as you said before, a rough estimate around 20 to 30% of his portfolio on Meta, and then he decided to sell, and he sold at, like, when the stock was at 100, and now the stock is at 500, and you're like, wow, this is probably, I mean, the top five of the best investors in the world, and even he makes mistakes. And the other one was Bill Ackman, that he sold Netflix when it was in around like 150 after like 6 months, and he lost, I don't know, like $1 billion in 6 months, and now the stocks is reaching like 650. And again, that the reason I mentioned this is obviously not to, like, there's a lot of, I don't know if you've seen, but there's like memes around internet like making fun of Ackman because you know how he's very vocal and how, but I mean, obviously, that's not what we learn from this. What we learn from this is, like, even the best of the best make mistakes. So that is a good hope for us.
Well, yeah, and I mean, while that's true, at the same time, these really intelligent and wealthy billionaire investors, maybe it wasn't necessarily a mistake for them. Like based on their calculations, they determined at that time the cash flow that these companies generate does not match what the stock price is. And maybe they figured that they would reallocate to something else. But then the market, everybody else, might not be evaluating the companies the way that these guys are, and whether they're everyday investors or pension funds, and they're just blindly investing in companies sometimes. Maybe that's part of why, because I remember famously the late Charlie Munger saying, like, as much as he loves Costco, he wouldn't invest in it at today's prices. And that was back when Costco was only like maybe $200 or $300 a share. And then since then, it's tripled since Charlie said that. So, he only said that back in 2021 or something. And he was saying, like, oh, the pension funds will keep investing in this. And then, so we see, like, I don't know if the pension fund calculations are better than what Charlie's estimation of Costco was, but was Charlie wrong? It's like, is the market more right just because they keep investing in these companies, even if the higher price to earnings ratio may not justify the earnings. Like it just keeps pumping up the PE ratio, but is that the right way? Is that a true reflection of the company's value just because the stock price is now up?
Yeah, you're right, and that is a great point because yeah, because that's true. Because the price is way up, it doesn't mean it's right, and it doesn't mean the intrinsic value of those companies is right. So that's what it makes you think. But at the same time, I mean, it's just been so massive how big Netflix and Meta gone up since they sold that is just like something to mention because I believe it's like I believe yeah Lilu sold when it was like at 150 and that the stock is almost hitting 700. So I mean it's a variability of almost like 500% basically. But yeah, I mean as you said, that doesn't mean I mean, at the same time, it would be hard to believe for me that companies, I mean, it can be obviously overvalued, but I mean, by so much, I don't know, it makes me doubt. But
Yeah,
yeah,
well, and also it's hard to say when some of these companies are the only main investing opportunities in the market right now. Like as expensive as they might seem sometimes, maybe there's not much better opportunities for most people, or most people just keep investing in their 401k funds. Like I know I am, and by virtue of doing that, and like if we're in the S&P 500 index fund, what happens is more of our money keeps going to the top companies in the S&P 500, which is the usual big tech. So even without trying that hard, many Americans are increasing the price of these companies just because like you're doing that every day with your 401k investment. So you're even though we're not trying to pump up the big tech, it's happening because of the way the indexes are um, allocating more of the contribution. So it's not an equitable investment. Like every time somebody invests in the S&P 500 index fund, like in many of the types of mutual funds or ETFs that are offered, like it's not like an equal proportion goes to Apple as goes to whichever company is number 500. It will disproportionately give more to Apple, like invest in that than into company number 500. So you can see the big just keep getting bigger. And that's part of something that it could be a phenomenon happening is like maybe people don't mean for these companies to keep getting pumped up in the market, but it's just happening by default.
yeah, I mean, that's it. That is a great point, and especially because I mean, I don't know, I could say more than 80% of those people that invest in the 401k, I mean, they don't even look and they just like are advised, and the thing is an automatic thing that they don't even ever change. But another thing that reminds me of talking about these like big things is that I mean the concept of diversification, which Buffett always talks to us, and as I always mention, this word is like is very sensitive because obviously we are taught in academy and all to diversify, and that is the secret not to. But I mean everybody can do average, but Buffett always has taught, and that is something that Lilu and Mr. Ackman apply, and it's just like I mean, why everybody's like, why to put all your eggs in one basket? And I mean, and that is the reason how Buffett got rich. Obviously, he today he has thousands of companies, and the reason is because there's not that many companies he could invest that are so valuable as all the money he has. But honestly, the way to get rich, like he always taught us, is invest in your 5 or 10 best ideas. Obviously, uh, it could be risky if you don't know what you're doing, but if you know what you're doing, like they did, and most of the people that do try to do this type of investment knows, they know more than anybody about those companies. So, and it makes sense. I mean, at the end of the day, it makes sense. Why invest on your 20th or 15th idea when you can invest on your 1 to 5th or I mean at the most 10 idea. So the concept of diversification is something that is very different in reality that what it really is. So, I mean, if Buffett always taught us, if you want to become rich, invest in your 5 to 10 best ideas. And no, you're just going to do average. And this is a very important concept because most people just always, people that are not in finance are like, oh, you just diversify. And I mean, obviously, I'm not saying not to do it. I'm just saying that's not what Buffett teaches, and that's not how he got rich, and that's not how Sam Walton got rich, and that's not how Mr. Ray Kroc got rich. I mean, they put all their money in Walmart, they put all their money in McDonald's. So that's a pretty interesting concept.
Yeah, for sure. And I haven't always been good at doing that, of concentrating a lot in one, because it can be a little scary if you have even a little bit of doubt, like to fully be invested in one thing. So I have a few also, but I try not to be too excessively diversified. Like even though I have a 401k through work, but it's only because when you are offered a 401k free match from the employer, people should definitely take advantage of that. So I definitely am, because why say no to free money when your employer matches your contributions to the 401k? So I have a little bit of index funds that I'm invested in, but most of my money is usually in individual stocks. So not too many, like you said. So I try not to be overly diversified in most of my money that I can control. So it is in not too many, like you were saying. And also I have a little bit of cash from just wanting to have a cushion, like getting ready, just like Warren Buffett has over $325 billion. I also want to have some cash so I can invest if we have a market drop.
Oh, yeah, I mean that makes all the sense. And now that you said, I mean, and one of the big things about those 325 billion is that there's not many companies that are going to move the needle. So that is one of the biggest problems. And I mean, him selling Apple, even though, as we said, I mean, it's the right thing, obviously for him because he probably valued the company. Now you think, where is he going to put the money? Because if you start thinking about it, I mean, most of the companies that are valuable, they're like in sectors that he just thinks he cannot predict. And it makes sense. I mean, technology is very difficult to predict. I mean, how is Nvidia going to look in 10 years? How is well, I guess Google and them, I think they're easy to predict, but um, yeah, a lot of the opportunities are just very, very hard to predict, and that goes completely against his principles. I was reading his letters the other day, and I remember how he always says, everybody, why new technology, AI, all this, it just brings excitement. But at the end of the day, when you're going to invest in any of these companies, you have to write in a piece of paper how you think at least is going to play out, like how is going to AI make money, because everybody's like, oh yeah, it's going to change the world, this is great, and yeah, and it is, but what company is going to win? How we know a company is going to win, especially in this rate of change? I mean, it's just like change is good for us as consumers, but not for investors because it's very unpredictable, and when change is so present in so many things, it's just hard to predict, and to be able to make a good investment is almost impossible, and it's a lot of, I don't know, guesswork.
Yeah, and while technology could be fundamentally beneficial to humanity, like the invention of cars or airplanes, but we've seen those industries, like the airliners and the car companies, they don't do that well financially. So we have a rat race of everybody's trying to get in on this. And Buffett reminds us through his letters or at the Berkshire Hathaway investor meetings that once upon a time there were thousands of car companies, and then it whittled down to just the few who could figure it out. And I think probably similar with airplane companies, so many people tried figuring it out, but very few can consistently make money at it. So even though there's a lot of promise and it's very beneficial to humanity, but making a business out of it is another story. And speaking of the letters you mentioned, it reminds me of something that Buffett said that Berkshire is doing this year, which kind of seemed a little foreboding. Like, I remember in this year's letter, he kept referring to back in like 2008, like getting ready for a big financial storm. And he mentioned it at least twice. So I thought that was interesting because throughout this year, he's just like doubled the cash pile. Like it's way more cash than even I remember a year ago of how much Berkshire's holding on to. And he's said this multiple times in recent years of how Berkshire will always be a financial fortress. And I wonder, like I know he's not trying to predict anything, but he's like saying when and if there's a big market crash, we will be ready and other people won't be ready. Like they will be a lender of last resort. For example, if say a lot of companies that will run into trouble eventually the next time there's a big economic meltdown, if they can't get the loans from the government or elsewhere, they might turn to Berkshire, and Berkshire will give them a lifeline to get out of the mess. So I feel like he can sense that probably something's brewing, but we don't know when it's going to bubble over.
Yeah, I mean, yeah, I agree. He might sense it, but I don't think he's like uh basically getting cash just to because I mean, anyway, it's too much cash. I mean, it's just I mean, it's an I mean, I don't. There's not even so many companies that are valued so high. I mean, there's not even that many companies that will need so much money as he has. It's just crazy. But now that you mentioned the airlines and the car companies, I think there's not better example than that about how a product that changed the world didn't make any money. And it's funny because every time somebody's criticizing airlines, because I think it's something very common in the daily life of all, like how they complain about airlines. But if I always try to tell them, if you guys knew how bad of a business it is, you actually be thankful that there's still airplanes or airlines because awful business. I mean, there's so much capex and then it's just like commodity business basically.
Yeah.
So yeah, I mean, airlines and cars are definitely the best example of how something really changed the world. And I mean, nobody made money basically, as you said.
Yeah.
So um, now we can talk about the good businesses like
Mhm.
a Geico, which we can talk about good businesses like a Coca-Cola. We can talk about good businesses as Seas Candy, and there, I mean, obviously we go into the other side, but that's what we and Buffett has taught us to look into. Companies different from cars that they don't have a big capex, they just keep throwing you cash and you don't really have to keep investing on it like a Six Candy. I mean, I think um, for those people that may not know, I mean, this is a company in California that sells the candies and it has this big moat because it's just present in the minds of um, everybody. And the reason we mentioned this is because this really was when Buffett's evolution came through. Stop buying like these huge textile companies where like the assets were very, very big, very heavy asset, and um, switch to very capital-light companies, but with the power to just keep throwing cash and throwing good, easy decisions after one and another. And this was, he always says, this was the reason he bought Coca-Cola because he understood the power of the brand. The great thing about Sis Candy is that it just worked in California, and they tried to expand it to different places in the United States, and it never worked. And again, to me, this is just a learning thing and how I mean, in business, you just don't understand many things. I mean, and professors in universities and in places, they love to just try to explain and give a reason. And Buffett, the best investor in the world, he's like, we just don't know. I mean, it just work and uh, the customer is the one who votes. Why Dr. Pepper's has I don't know 27. I don't really know the states, but I know he has 27% of the market in certain state and 3% in another. Why this happens? And this is what we have to ask us. But many times there is no answers. But for going forward, like for those people that want to start a business, just always having these great businesses in mind is a way because even though I always talk about restaurants, I repeat myself in restaurants, but it's basically what it comes to mind when I want to give an example. And is don't open a restaurant if you're not going to have a moat. And obviously in restaurants it's very hard to have a moat, honestly. I mean, I just think either you are that low cost producer, which starting out is probably going to be impossible. And I think in restaurants these days that the only way to become and build a moat is through a lot of good experiences, and this takes years. And in any business that we get into, if it's not in the investing part, like startup or anything, you have to keep in mind that you need to have a moat. If not, you're just going to be average, and it's just going to be a hard decision after a hard decision. And a lot of industries have advantages, but and yeah, definitely don't start an airline.
Yeah. Well, and speaking of restaurants, one investment Berkshire made this year that we've talked about that you presented the investment case for was Domino's Pizza. So interestingly, Berkshire invested like $500 million into Domino's. And I remember learning from you that Domino's had a lot of debt, but somehow, maybe in spite of the debt, Berkshire sees an opportunity with Domino's. So I find that an interesting case study of maybe Domino's is one of the few companies that has a moat around its brand, its pizza. Like people will still buy pizza even in a recession. So maybe there are some pros for Domino's in spite of its big debt load that it's probably not going to go out of business. It's probably in using innovative technology to enhance customer service and delivery of their pizzas. Like they're probably doing things that, despite having a lot of debt, they might show a lot of earnings promise in the coming years. I don't know, but that could be something, that is meeting some of Buffett's principles of what he looks for in a company that can, withstand the vicissitudes of life, like Charlie had said.
Yeah, absolutely. And yeah, obviously one important thing to mention about Domino's as a restaurant is that like they most of their things are franchise. So basically they're even though they're a restaurant different than McDonald's, they're very capital light. And I mean, in one of the shareholder meetings, some shareholder asked Buffett what was the difference between Dairy Queen and McDonald's, which they both sell burgers, but that's exactly the difference. Dairy Queen is franchise, I don't know, 95%. McDonald's, I think, is been trying to go more franchise than before. I think they used to own way more of the restaurants, but definitely, I mean, it's again capital light, so not much investment and good returns on capital, which is the name of the game for Buffett.
Yeah, it's just an interesting model. Maybe we should cover that in a future time because we're coming up on time soon, but like it'd be interesting to evaluate companies that don't require a lot of capital expenditures, as you said, but can still grow and still produce cash flow without putting too much into it. And like we've seen with big tech, that's one of the reasons why big tech are so valuable is you don't require a lot of heavy duty equipment like farming does or heavy industry, and you can just keep producing services that people enjoy or want to use, like a lot of what Meta does. Like when people use social media, I imagine Facebook doesn't require nearly as much capex as, say, an oil refinery or something like that. So it's a very different business model, and being capital light in software related businesses can be very profitable, like we've been talking about.
Yeah, definitely. The problem in technology obviously is like how you get entrenched into the people's like computer, like for example, Microsoft does. I mean, that is a very difficult part. They're very capital light, but in the other side, Coke and them, like for example, yeah, talking about that, I don't know if you remember, but Coke got rid of, I mean, they did a contract to sublease their or they sold their bottlers again because they wanted to work in the brand and just get the syrup, and that's the big profitable part of Coke. So, but yeah, definitely that will be an interesting topic to cover.
Absolutely. So this has been great going over Buffett's principles throughout how Berkshire Hathaway invested in 2024 and reflecting back on some of the investing decisions that Buffett and Berkshire have made this year. It's been awesome talking about them with you, Alejandro. I'm grateful that we could get together. Thank you for talking to me about these subjects. I'm just so happy that we can keep practicing our investing because that's how we get better by continuously studying and thinking about these things and reflecting. How can we be better investors based on learning from the best investors out there?
Yeah, absolutely. Thanks, Michelle. It went by fast.
Yeah, time goes by when you're having fun learning of how to invest. And so I wish you, Alejandro, and everyone in our audience a happy holiday season and all the best in 2025.